Hello and welcome to the accounting equation. So there are so many aspects that go into the accounting equation, and I know that if you are in the financial accounting and principles one, then you may be struggling with just the basic idea of the accounting equation and how it all works. So this video is going to go through what goes into the accounting equation, how do debits and credits affect it, and we'll walk through some journal entries to go along with that. So hopefully this is helpful to you. So the first thing is, let's take a look at the accounting equation. We know that it is assets equal liabilities plus owner's equity. So we always have to have that balance. That's super duper important. And remember, assets are things that you own. That's things of value. So we know that some of the things that fall under there are cash, and that can be cash in a bank account. That can be cash in, in the cash register, in a savings account. Anything that is super liquid you can get your hands on is considered cash in that way. Accounts receivable are assets. Remember, accounts receivable is when a customer has purchased something or you've done a service for the customer and they have not paid you yet. Accounts receivable is not a bad thing. That's a good thing. That is an IOU that somebody's given you and you trust that they are going to pay you. Short-term investments. So this is something that you have invested in the stock of another company perhaps, and you can get that money out quickly if you want. It's not tied up for a long time, but you've put it in there hoping to earn some kind of return. Inventory. So this is if you are a merchandising company, you have products that you're going to sell. This could be that you are selling cupcakes and this is the sugar and the flour, or this could be the cupcakes that are already ready and made. That we'll dig a lot deeper into that in managerial accounting principles too. But inventory is any asset you have with the intentions of selling it to make revenue. That is your normal business operations. Then there's equipment and machinery. This could be vehicles. Maybe this is a delivery vehicle. This could be a machine that you use to produce your product. Any kind of machine or equipment, this is something of financial value to you. No, you're not trying to sell that piece of equipment to make normal business operation revenue. You may sell it down the line and make a gain or a loss, but you are bringing in revenue with this because you are using it to either deliver your product or to manufacture it in the first place or something along those lines. Your building is an asset. So this could be the building that you're using to manufacture your product, to hold that product like a warehouse, or it could be the building that you are selling your product in. Or if it's an auto shop, it could be the building that they are fixing vehicles in. Then there's land. So land is obviously a valuable asset wherever you've purchased a piece of land. Maybe this is where your building is, or this is a piece of land that you're going to buy to put a building on, but that land is an asset. Our liabilities, we know, are the debt that we owe or an obligation we have to someone else. So one of the first ones we always see with that is accounts payable. So accounts payable is where we have purchased something from a vendor, a supplier, and we owe them typically in the short term. Now, there's usually an invoice to go along with this, but it's not usually something that you signed official documents and, sat down with a notary or anything real official like that, but you do owe somebody money. Maybe you've bought a truckload of fidget spinners and you're going to be selling that for your product, and you owe that company that sent you the fidget spinners, that wholesaler, and you're going to pay them in a month. That is accounts payable. Salaries payable. So we know that most people are not getting paid in cash. So you might do 2 weeks of work and then get paid. And if that overlaps between 2 months, so let's say we're at the end of February, we've had employees do work for us, but we're not paying them till the beginning of March. We need to go ahead and show that we owe them, that we have these salaries payable so that we can show that we owe them money for the work they've already done. Taxes payable, very similar. So we owe the government taxes. That's something you're going to record a tax expense every month, even though you won't actually be paying the taxes except every quarter, most likely, or sales tax it is every month. You'll be paying it the following month, but you're putting that aside saying, I owe the government this, and I know that I need to pay them. That is a liability. Also, there's interest payable. So same idea here where we are going to have to pay interest for a loan. Maybe it's not due yet, but we know we've already incurred that interest and we're going to have to put that aside as an amount that we owe. The last one I'll mention in liabilities is our notes payable. Even though that's not the only liabilities there are, these are some of the main ones we see. A notes payable is very similar to accounts payable, where we owe someone that is, sold something to us. We owe them money, but this is much more official. This is typically long-term, not always, typically more long-term, but this is more official. Maybe they've loaned us money. Maybe we bought a piece of equipment from them. Maybe we've bought a building from them. And this is a very official loan. This is a very official note that we have signed. Yes, we are going to pay this back in X amount of years. And there's typically going to be some interest involved in this, where with accounts payable, you wouldn't see interest. So notes payable, typically long-term, but not always. It's going to be more official, and there will be interest that is having to be paid as well. So if we've got all these things that are valuable to us, our assets, and then we have the amount that we owe, our liabilities, any kind of obligation, what do we have left over? That is going to be the part that we actually have ownership in, or that whoever owns the company has ownership in. That's where we get our owner's equity. So there's several things that can fall under owner's equity. The main two that you'll see in Principles 1, especially in the beginning, is going to be common stock. So this could be where the owner has put money into the company, or this could be where they are selling their shares of stock publicly, and there are lots of owners in the company, but this is ownership where people have put money into the company. And then retained earnings. This is the trickiest account for most people to grasp this concept. Retained earnings is just reinvested profit. So at the end of the year, they're going to take all the net income, the revenue minus the expenses. They're going to take that net income and they need to zero it out so they can start fresh the next year. So they're going to put that into retained earnings. So retained earnings is reinvested profit, where common stock is money that owners put into the company. They didn't earn the money. That's where they wanted to have a part in the company. Retained earnings, they did earn that, whether that was from their normal business operations, or maybe they did sell a piece of equipment or something like that. So this is the accounting equation. Now let's talk about how this is affected with debits and credits. So a normal debit balance would be the asset side. All assets have a normal debit balance. Whereas the liabilities and owner equity accounts, they are all having a normal credit balance. Is a debit good? Well, it depends on what's happening to that. Is a credit good? Depends on what's going on there. So we're going to look at different transactions. It's not that one's a positive, one's a negative. It's just depending on which side of the equation it's affecting. So for the T accounts, these T accounts are so helpful. They might feel really tedious in the beginning, but I'm telling you, every true accountant I know says, yes, I love T accounts. We work with T accounts. We take paper and pens or pencils and we write out T accounts when we get confused, because this helps to really see how the balance or the amounts have traveled through different accounts. It can really help to solve a puzzle. Accounting is a lot about puzzles. So hopefully you like puzzles since you are taking an accounting class. So if you have something on the left side of the T account, that is going to be a debit. And a debit would increase anything with a normal debit balance, which would be assets. If you debit a liability or owner's equity account that has a normal credit balance, you'd be decreasing those. Whereas on the right-hand side of the T account, that would be your credits. If you credit something with a normal credit balance, a liability or owner's equity account, then you are increasing that account for better or worse. If you increase accounts payable, well, I owe more money now. If I increase common stock, well, there's more ownership in the company now. If I credit an asset that has a normal debit balance, then I am decreasing that. So if cash goes down, I pay out cash, then I'm going to decrease my assets with a credit. So hopefully that helps you to understand the T accounts and the debits and credits a little bit better. If it is a normal debit balance, if it's an asset and you debit it, it increases. If you credit a normal debit balance, it decreases. If you have a normal credit balance and you credit that, it increases. If you debit a normal credit balance, then it decreases. I know this is very counterintuitive to what you have likely learned when it comes to the banking industry. So a lot of people struggle with this for that reason. All right, so we are going to go through a handful of transactions that we are going to record for this company. It's called Hands-On Automotive. So the first transaction you're typically going to see with a company is going to be the owner putting money into the company. So the owner contributes $50,000 on January 7th. The first thing we want to do is think about how does that impact the accounting equation. The owner put cash into the company. So cash is an asset, which is a normal debit balance. So we're going to take the account cash, and we also are going to take common stock because this is where the owner has put money into it. That's a owner's equity account. We are going to debit cash for the $50,000 because cash is an asset with a normal debit balance. We have increased how much cash there is, so we're going to increase with a debit cash. Common stock, we have increased as well, but that's a normal credit balance. So we are going to credit common stock. And then here's the journal entry to go along with that. We always want to start with the date, January 7th, as it tells us above. And you see here on the T accounts, we also put the date, which is very helpful because then you can track it to the journal entry and the transaction. We always want to list out the debits first. So we have cash is a debit of $50,000, just like we saw here. And then common stock is a credit of $50,000. And see, it lines up well. We've got our debits on the left, credits on the right. You could think of this as a T account right here. And then it's always good to put some kind of description. I'm putting very vague descriptions on these journal entries, but in reality, when you are actually working at a corporation, you want to put pretty specific details as to what that transaction was, because someone will likely have to go back and look at it, especially if it's an unusual transaction, to see exactly what happened. So you don't want it to be super vague. You want to put a description in there. I literally worked for a company, a small company that had not had a true accountant in there. And people said, oh, we've just been making journal entries. We don't really understand them. And their tax accountant started asking me questions. And he said, what is this transaction? What's this transaction? And literally the description they had put for the transaction is, we have no idea what we're doing. That was the description. And then they wanted me to explain to them what they did. I'm like, I didn't work here at that time. I have no idea what they were doing. So put a good description, especially if you don't know what you're doing, because that way we can follow it along better when we need to correct it. All right, the next transaction. On January 12th, Hands-On Automotive purchases a building to conduct business in for a down payment of $30,000. The total cost of the building was $300,000. Okay, so we just spent $30,000 in cash. We had $30,000 go out in cash. So that's the first thing that's going to be effective. We also have a new asset. We have a building. And we also have a notes payable, right? So we've got to pay somebody for this. So for our cash, remember we already had this transaction. We're going to keep showing everything that happened in cash. So we had 50,000 come in the last transaction. Now we have 30,000 going out because we spent that for a building. Is that bad to credit cash for 30,000? Is that a bad transaction? No, I mean, they invested it in a building. They can't just sit there with 50,000 in cash and have no building to repair cars in. So this is not a bad thing. It's not a bad thing to credit an asset necessarily. They acquired a building for $300,000. So that is an asset. So they increased that asset by debiting because it has a normal debit balance. And then we also see that notes payable is going to be increased. Remember, notes payable is a liability, has a normal credit balance. So we're going to increase that with a credit for $270,000. It did not tell us that anywhere. I'm reading through. How in the world do we figure out that we're crediting notes payable for $270,000? Well, if we bought a building for $300,000 and we only paid $30,000, the difference is $270,000. That's what we owe. A building, any kind of mortgage, that's going to be a very official contract. This is not accounts payable. This is very official. They'll be paying interest on this thing. We don't have to record any interest right now. No time has passed, but a notes payable is going to be for that official loan, that note that they sign. And we see in this journal entry, it's got 3 different accounts that it touches. We have a debit to building for the $300,000. We always start with the debits. Then we have 2 credits. We credited notes payable for $270,000, credited cash for $30,000. It didn't matter if we put cash first or notes payable first, just as long as the debits come first and then the credits second. All right, and then we just put the generic building purchase on this one. Okay, now we're at January 20th, my daughter's birthday. And they purchased equipment with cash to assist in repairing vehicles for $5,000. So a piece of equipment, what kind of account is that? That is an asset. They purchased it with cash. So we're going to see cash and equipment both affected, both are assets. So we are going to see a credit to cash because we are decreasing cash and a debit to equipment. If we think about the accounting equation, it always has to balance. If we have our assets, they increased by $5,000 for equipment and they decreased by $5,000 for cash. So nothing happened on the liabilities and owner's equity side. It all happened on the asset side. We increased and decreased that side, which does result in it being balanced. So this would be our transaction. We put our debit first, except I added an extra 0 there. That would be a big mistake. If you're doing this inside of an accounting system, it would say, nope, that does not balance. So it would catch your mistake because we are all human. And as you can see, I also make mistakes. So our equipment on January 20th would be debited for $5,000 and our cash would be credited for $5,000. Okay, so now we are at January 25th. They purchase office supplies to be paid for in 30 days for $2,000. So office supplies is an asset. If this is, let's say it's copy paper and pens and things like that. This is an asset. It will be used up much quicker than any kind of equipment or building or anything, but it is an asset that they will be using. Now, is cash affected here? Well, it says that they purchased it to be paid in 30 days. They have not paid any cash yet. So we are going to have to record a liability because they owe them. And this is most likely very informal. Hey, here's the invoice and here's your copy paper. You need to pay us in the next 30 days. No interest, no signing documents. Maybe they signed to say, yes, we received it, but no like official, let's sit down and sign all these documents. So this is going to be accounts payable and office supplies. We are increasing the asset office supplies. So we are going to debit that. And we are increasing a normal credit balance, a liability for accounts payable for $2,000. So we credit that. So I think you're getting used to it. You know what the journal entry will look like? We're going to have the date. We debit office supplies, our asset. We credit accounts payable. right, just a few more transactions here. On January 26th, Hands On Automotive fixed their first vehicle. Yay, we're finally earning some revenue. They earned $1,500. I feel bad for the customer because I've been there. We've all been there where we have to pay a ton for auto repair. They have to pay that in 15 days. Okay, so they earned revenue. They've already done the work. So they do get to show that they earned revenue. But they haven't got any cash yet. So what is it that we would debit? What asset would we want to debit when we haven't received cash, but we do get to record that we already performed the work? That would be where accounts receivable comes into play. So we are going to debit accounts receivable, asset account. That's great. Hey, we made a sale and they are going to pay us $1,500, hopefully within the next 15 days. And then you have revenue that has been credited. Now, this is where it gets tricky. Why is revenue credited? Remember, revenue is going to show up on the income statement. It's going to be at the top of the income statement. The income statement is revenue minus expenses. And then you get your net income. The net income ultimately gets rolled up into retained earnings. Retained earnings is a normal credit balance. Not everything with a credit balance is bad. Not everything on the credit side is liabilities. There's the owner's equity section. It's a normal credit balance. So revenue increases retained earnings. It increases the profit we get to put back into the company. So we credit revenue. Whereas with expenses, which I didn't even put an expense entry here, I should have, expenses always debit, because they are decreasing what will ultimately go into retained earnings. So we are going to credit revenue for $1,500. That's a good thing. Credits are not bad, not always bad. So this is January 26th. We are debiting accounts receivable. They owe us. We believe they're going to pay us. And we've already done the work. So we get to credit revenue. All right, on January 27th, they pay their debt in full for the office supplies that they purchased on January 25th. So remember, they purchased those office supplies for, what was it, $2,000? Let's see, wow, I've got things popping up here at the wrong time. So for $2,000, they had purchased office supplies. We had debited office supplies, and right here we had credited accounts payable. Now we are getting rid of that debt. We are paying it off. So let's take it out of accounts payable. And we are giving them cash instead. Is it bad that we're crediting cash? Well, we no longer have that debt. So that's a good thing that we're paying it off. So we are debiting accounts payable, which is a liability with a normal credit balance. But this is what we want to do. We want to debit it, because if it's a normal credit balance and we debit, we are decreasing that account. So we are decreasing what we owe. Now accounts payable will be zero. Then for our cash, it's a normal debit balance and we're giving some of it away. So we are going to decrease that with a credit. So that's how we're going to show paying off this debt. All right, our last transaction here. I believe this was the last one I had on here, and then we'll look at all of the accounts and how they balance out. On January 31st, they receive all of the owed money from repairing the vehicle on January 26th. So remember, we earned revenue of $1,500 just a couple days ago, and now the customer's paying us. So now we're going to get cash. They owed us, I keep having this thing show up at the wrong time. Whoops, there we go. So they owed us $1,500 in cash. And now they gave it to us. We increased cash, so we're going to debit cash for $1,500, and we're going to credit accounts receivable. So cash, or all assets, have a normal debit balance. We want to increase cash with a debit. We want to decrease accounts receivable. Accounts receivable is great, but you know what's even better than somebody owing you money? Somebody paying you money. So we're going to decrease accounts receivable with a credit. And that's what we're going to do in this transaction, saying, hey, customer, you no longer owe us. Even better, you gave us the cash. So obviously there'll be lots and lots of transactions like that. Hopefully going over these will help whatever you have already learned in accounting, the first principles class. At the end, though, you're going to take all of your accounts. So we'll look at the asset accounts first, and we'll figure out what the balances were. So we had cash, accounts receivable, building. Got these things coming up all different ways here, don't I? I got a little out of control there with the animations. So cash, we started with 50,000. We had to pay for several things, and then we had some revenue come in. They paid us cash for 1,500. Ultimately, our ending balance, whichever side of the T account you have more, the higher amount on, not necessarily the most transactions, but the higher amount is the side that there's going to be a balance in. So we add these two debits together, subtract out the credits, and we end up with a debit balance of $14,500. So that's how much we should have in our cash account, whether that be our cash register, our bank account, however we have cash. Our accounts receivable, they owed us $1,500 and then they paid us. So it actually has a zero balance right now. Our building, the building stays at $300,000. Even when you get into depreciation, the building itself is going to stay at the cost that you paid for it until you sell it, or maybe make some additions. The equipment, we still have that equipment, nothing changed. So we have a debit balance of $5,000, and then office supplies, same. As we use some of it up, we'll start crediting that. Maybe we use a box of paper, we'll credit office supplies for a portion of it. But right now, this is how we ended. We had $14,500 in cash, nothing in accounts receivable. So that really wouldn't even show up on the balance sheet at this point. Then we have our building of $300,000, our equipment for $5,000, and office supplies for $2,000. Then our ending balances and liabilities and owner's equity look like this. I really should put a line down the middle here. We've got accounts payable. We owed somebody $2,000, but then we paid it, so we don't owe them anything. And then we have notes payable of $270,000. That's funny how I have that coming in. Because we owe on that building. As we start to pay that off, we would start debiting it, but we didn't do that yet in these transactions. Then for our common stock, all of these are credit balance, normal credit balances. Our common stock, they had put that 50,000 in. We haven't given them any of their money back, so we've still got a credit balance of 50,000. And then our revenue, which would ultimately go into retained earnings at the end of the year, is a credit balance of 1,500. We haven't put any expenses on here yet. If we were to add together all of these credit balances, they would equal the debit balances on the asset side. If they didn't, that means there's something wrong. That's where we do a trial balance. We check to make sure all the credits equal all the debits. If they don't, we start tracking down what did we do wrong there. If they do, we start creating the financial statements. Now we can put these numbers into the balance sheet, and we can make the income statement, the statement of retained earnings, and the balance sheet. So hopefully this refresher helps you with anything you may be struggling with here in the first section of accounting, the beginning class of accounting. But please feel free to reach out with questions.